So Dani, who got burned in this? Because we had reports that all the hedge funds were just piling into tech, into tech.
Certainly.
Somebody must have lost.
And to be clear, they've continued to pile in June also. This is a very recent piling in. I think it's interesting Mike mentions breadth because we had last week tech, the 52%, people who were above their 52%, 52-day highs had reached a new high for tech. But I think when you look at who really got hurt, what kind of movement this is, honestly, this is a bigger story, I think, than just tech. If you look at what sold off, you can clearly predict how much things sold off on Friday and Monday by how much of a momentum share it was. Like, the correlation is so clear. If it had gained more over the past year, it had lost more. You take a company like IDEXX Laboratories. It's not a tech company. It's a pharmacy for pets, veterinarian products. It sold off a lot, and it's the 12th biggest momentum name in the S&P 500. So from that view, and back to your question of who got hurt the most, this looks more like a systematic sell-off. Someone who had a momentum position, it could be a quant, it could be a very computer-driven strategy, but it was very clear this delineation of what sold off based on how much it had gained. So for that reason, I think it's not anything to be overly concerned about, that all of a sudden tech is going to be ruined, just because it does seem like it was a very specific player that either did the majority or sort of acted as a catalyst for people to take profits off of this richly valued tech sector.
So Mike, is there any message in what's just happened to tech in underlying fundamentals, or is it all positioning? Is it all technical?
No, the positioning is always what triggers it. And look, we've been writing about this for the last several weeks in our weekly note about how these cyclical areas have been underappreciated this year, that people have kind of thrown them in the garbage can thinking that the economy was slowing. So where are we now? Think about we're halfway, almost two-thirds of the way through the second quarter. We're pretty confident that the economic data is going to be much better going forward. So we're looking for a 3% plus second quarter, which follows a first quarter of 1%. It's being driven by capital expenditures, which is actually a positive signal for tech, because all that capital spending is in that area. And so, but as growth improves, economic growth, what usually happens is the value cyclical areas do better. And we think there is a signal in this, that's part of this message last week, that it's not that the value stocks are going to run away with it like they did last year, but they can at least participate. I mean, they really have underperformed significantly, and we think it's just gone too far.